Hey there, speculators. It's Rod, your futures fanatic. Welcome back to the channel. Let's talk about micro E-mini options on futures contracts. And specifically, we're going to talk about these right here, and more specifically tonight, the Nasdaq 100. Before I get into that, though, I do want to remind everybody this video and everything I do here on YouTube is for educational purposes only. Make sure you read the risk disclosures and disclaimers. Don't eat yellow snow. Look both ways before crossing the street. You know the drill. All right, let's get into it. So right now is the time I'm making this video, although I'll make it, as they say, evergreen or whatever, so this education will be useful regardless of what's going on in the market. But right now, specifically, the markets are declining. They're about 5, 6, 7% off of their highs at the time I'm making this. And that sets up really nicely for trading options on futures, specifically being short puts, which I'll talk about in just a bit. Being short puts is a higher probability trade generally than being short calls because the market has a positive skew. Let's talk about three things tonight. The first I want to just really briefly cover on the basics, but basically the basics, I'm just going to point you to the page that you're looking at right now. The next thing that we're going to do is talk a little bit about the contract specifications in terms of how they kind of work, just at a very high level. Two important concepts that I'll get into. And then the third thing, a trade that I'm in right now, I'll tell you a little bit about how I'm managing it and what my plans are for the rest of the week, because it's earlier in the week right now and this contract expires on Friday. All right, so let's get into it. First and foremost, everything futures, the CMEgroup.com is your friend. So I'll leave a link to this down below. This is to the micro E-mini options page where they specifically cover the contract specifications behind the S&P 500 and the Nasdaq. The symbols for that is MES and MNQ. That's the underlying symbols. The actual symbols for the contracts are pretty wacky. That's probably going to be in another video. Each options chain, we'll look at a couple of tonight. It can get a little confusing, but you just want to make sure you know basically what you're doing, but you're going to mostly stay to the week in which you're trading. At least that's how I do it, and that's what I'm going to be teaching and training on right here. So anyway, I'll leave a link to this down below. Check the description, and you can find out a little bit more about the contract specifications. They have a nice FAQ, and this all about options, all that good stuff. All right. Now let's get into the next thing, sort of the contract specifications. I have two platforms open tonight, one on the web and one more of a thick client, but they're actually connected to the same broker. So this is Gain Capital or StoneX. This is their web interface, and it's called, I guess it's called iBroker or whatever. And then I also have this thick client here, and this is the options chain right here. I am currently in a position where I am short two contracts of the 14,800 puts. Okay, those are currently, at the time of making this video, in the money because the Nasdaq futures are trading at 14,732. So those are 70 points in the money. If right now was expiration and we were at 4 p.m. Eastern Standard Time on Friday and these were in the money by even $1.50, I would be assigned. Here's the most important fact that make options on futures or futures options much more, in my opinion, much more powerful and easier for beginners to trade than stock options. Stock options are great, but those either know stock options, they represent 100 shares of the underlying stock. Okay, 100 shares of an expensive stock is expensive. That's a lot of shares. These two contracts that I'm short, and I'm short from right here, like, let me just draw a little picture here. I'm short from this strike right here, well, from this level right here, from 14,800. The current market, I'm a little anal. I hate when lines aren't sort of whatever. I could have made that just a horizontal line, I know. But anyway, there we go. From about 14,008, right there, okay? Now, the market is 70 points below that price. I sold these for, let me see if I can use my drawing tool over here. This will be kind of cool. I sold them for about 175. 175. Geez, can you even see that? 175. There we go. So I sold them for 175. Now, here's the first part of this lesson, to keep this extremely simple, is you have to know the point value of the underlying instrument. The point value of the MNQ is $2 a point, okay? Now, if all this is completely new to you, you're going to want to spend some more time on that page that I referenced below, the CME group, and just get a little bit familiar with futures. If you don't know the underlying, you're going to have a difficult time getting this. But if you're interested in this whole thing, and believe me, futures are the way to go when it comes to active intraday trading, not stocks, not Forex, not crypto. The futures markets were made for speculation. They have no pattern day trader requirement. I created this whole channel because I am truly fanatical about helping people understand the power of the futures markets, especially if you are looking to develop and hone your speculative chops and your especially the lower time frames, your day trading time frames. Stocks and other things are great for investing for longer time frames. At least in my opinion, I know people trade stocks successfully, but the futures markets are where it's at. The next step after your education there is getting into these options on futures. If you'd like to learn more, obviously, like the video really helps the algorithm. Turn on the bell notifications, subscribe to the channel, all that good stuff. Okay, because I'll be doing more content about this. So the first thing to know, let me get this out of the way, is once again, the underlying contract, okay, is $2 per point. All right, $2 per point. Why? Who cares? Whatever. It's $2 per point. So in other words, when the market goes from 14,732 to 14,733, that's $2 up or down for every one contract that you were long or short. Hopefully you understand that concept. Now here's where the cool thing about the options come in, is that let's take a look at this 14,008 option right now. So I'm going to try to highlight it over here. It's a little difficult, but right in here. And I'll look to zoom in on this in post-production so you can see it a little bit more. It's trading at 157 by 162 and a quarter. Let me take a brief moment to point out these figures over here, okay, which are going to scare some options traders away, or some, the total volume, Rod, was 31 contracts. The total open interest is 62. Yeah, it's anemic. I get it. But here's why you don't necessarily have to worry about that. I'll talk a little bit about the strategy in some future videos. But the MNQ traded... Well, it's after hours. The market just opened up and it's already traded. We're only an hour into the extended session or the overnight session, and the MNQ has already traded 10,000 contracts, the underlying, okay? On an average day, it will trade between 500, 600, 700,000 contracts of the MNQ. So with that going on, I hope you can see the potential opportunity here, or I'll explain it to you. There is a lot of opportunity here to express these trades directionally using options and get paid for your directional trade. Now, here's what you do not want to be doing with these wide spreads and things. And you do not want to be doing this also because these options are deliverable as one of the underlying. And by the way, in just a moment, I'm going to get back to my description of the $2 per point. But here at 14,008, we're trading at 158 by 163. Okay? So if you were to buy this contract at 163, let's say, if you're going to buy it at 163, okay, what you pay for that is 163 times $2. Okay? And I went to California schools, terrible at this, but I think that's 326, right? If I'm wrong, that's really embarrassing. Let's call it 320, something in that. Now, you'd have to pay 320 for a put, right? You're buying the 14,800 put. You're looking for the markets to go down. Now, if you have a setup or a signal or a reason to do that, I don't know why in the world you would ever pay to do that when you could just short the futures. Just sell one contract and you're going to have 100 delta, and it's going to, if it goes down, you're going to be right, okay? But the flip side of that is what we want to be doing, or what I do, what I teach and train on, is if I have a signal and a setup to get long at 14.8, and the reason I got long at 14,800, these two contracts, was because we had a prior session low. I'm not going to go into the strategy and theory behind how we're doing the charting tonight, but just know that I had a signal in the underlying. I had a reason to want to express a trade by being short puts, in other words, a long trade, okay? And we'll get into that more probably in some future videos. If you would like to learn more about these particular strategies and just actively day trading the futures markets in general, and also how you can pass some of the prop programs and lower your negative mind that you got going on and all that good stuff, that's what I basically do in my trade room. We keep it really simple. We trade mean reversion and directional, and now with that particular style, we can do it in the options markets as well. You can find a link down below for how you can join the trade room. It's free for 2 weeks. There's no upbill, there's no resell, there's nothing like that. You don't have to put in a credit card. Don't worry about it. Okay, back to the 14,008. When I went to place this trade, I actually sold, remember we have our multiplier here, right? So our multiplier is $2 a point in the Nasdaq. By the way, in the S&P, why don't we cover a few things? It's $5 per point PPT in the MES. God, this pen doesn't look all that great. All right, so it's $2 per point in the Nasdaq, $5 in the MES. All right, so if I sold 2 of them, okay, times 2 times 175, okay? So basically 4 times 175, okay? And that shows you the net liquid options value here that I have of short option value about 652, right? About 652. It's really, it's 175 times 2, and then I have 2 contracts. Okay, that's the math there. And since the market has gone up a little bit off the bottom, these contracts are actually profitable. All right. Now here's the next really important concept that I think I've already mentioned, but I want to reinforce it once again, which is that these options contracts are deliverable as one of the underlying. Not 100, not 10. I've mentioned it in this video. I've mentioned it in this video as well. That is really, really important to understand, because if I did nothing with this position at all and the market were to stay right here or even decline more, I am essentially only obligated to be long 2 contracts of the MNQ at 14,800. My assignment risk in these is infinitely easier to manage. The other thing is that I don't have to necessarily spread, nor should you spread. These numbers right here are very anemic. You do not want to be working into spreads. You don't need to spread. Selling puts is the same as going long 1 contract. Okay, it's synthetically the same thing, essentially, and for the most part, not exactly the same thing, right? The deltas are different, but what we're going to be doing here is expressing directional trades and getting paid for doing so. By the way, the opposite would be true on the upside. If I wanted to get short and the market was way up here, I wanted to sell a 15,000 call. Now that's a short obligation. If the market were higher than 15,000, I would be assigned and I would be short at that strike. Okay, the assignment does not happen early. There's no pre-assignment risk or early assignment risk, and you are essentially the only margin requirements, if you will, are the same as the underlying. There's not officially margin in the purest sense, but there is a margin calculation that's used. So to hold this particular position on this particular broker, it requires about $1,600 per contract. So the account had about 5,500 in it to start the session, and that's enough to have about 2 contracts on. Okay, so this is perfect also for small account trading. So the final point on that is, remember, these options are assignable as one of the underlying. Okay, now let's take a quick look at a bigger options contract. At the web over here, so you can see this a little bit easier. I'm going to go to options. I'm going to go to indices. I'm going to scroll down to the micro E-mini Nasdaq. This is the expiration. By the way, they're weekly expirations and they expire on Friday. There is also monthly expirations and things like that. In what I do, since I'm just looking. This will be kind of new for a lot of more experienced options traders, is you can use these in a much, much more simplified manner. I know that a lot of people like to get into their Greeks and get into all these types of strategies. I almost never do any kind of strangles or straddles or multi-leg anything, because you just don't need to. All I'm doing is expressing directional trades and getting paid to do so. As again, a 1-to-1 multiplier. I would not be doing this. Again, if this represented 10 contracts of the micros, it would make no sense. Or 100, that would be the same as 10 minis. It would make no sense to do that. So, but the way these are structured, it's just perfect for the kind of style of trading that we're doing. All right. So right here, I'm going to click on this. So again, for those that are wondering, what do I trade in terms of days till expiration? I trade the one that's expiring on Friday. If I'm trading it on that Friday, it's 0 days till expiration. If I'm trading it on Wednesday, it's 2 days till expiration or 3 days till expiration. And that is because I'm just trading when I have a signal. I'm not trading willy-nilly or based on any kind of gamma or theta decline or into earnings. None of that stuff matters here. These are just stock index futures. So you can rid your mind of all that stuff of earnings. Like, here's the problem with options and a lot of trading. Traders will know this, is there are 3 or 4 dimensions. You have to get magnitude of the move right. Generally, you have to get the move right. Not all the time. I understand there's plenty of strategies that are neutral on that. But for the most part, you need the timing, you need the magnitude, you need the direction, all these kinds of things. With what we're doing here, I don't need any of that. I just need to get essentially the direction right. And if I don't get the direction right, here's the next thing that's cool about this is because this is assignable as, so again, I'm short. Let me just write this in here. So I'll just put it here on the screen so we can see short to 14,800 puts. And I believe it's like 9/29 expiration. I could be wrong, but something like that. All right, so that's my position right there. You can see that those are in the money, but I don't care that they're in the money. I could calculate what my break even is by the amount of premium I brought in, which was 175. So my break even is down to about 14,625, just below kind of where the lows were for today. But here's all the flexibility that I have in this. If I do not want to get assigned, if the market stays below 14,800 and I just do not want to get assigned these things, I can just short the underlying. As soon as I go short two of these puts and 2 puts that are in the money, it's offset. There's nothing else for me to do. There's zero assignment risk at that. Now, why would I not particularly want to do that? Because I don't want to treat any of these options positions. And again, another reason you might want to like, subscribe, turn on the bell notifications, find out more about what I'm doing here, because I haven't seen anybody that teaches and trains on how to do this. Mostly because I really, honestly, I don't know. I'm not sure. I think there's a lot more maybe money in courses and the Tom Sosnoffs and the Tasty Trades of the world. God knows those guys have more money than I will ever have, but they're encouraging people to do multi-leg options and lots of trades, trade early, trade often, whatever the hell they say, generate commissions basically. Okay, there are transaction costs associated with options and with futures. It hasn't gone away like it has in some of the stock market, but for most places, stock options still have commissions. I know they're free at Robinhood and things like that, but transaction costs are definitely a big component of this. So, but getting back to why I don't need to, hedge or do anything with this is because I'm just okay, first of all, being long at this level, because it's a level that I'm okay being long at and getting assigned. Secondly, it's the same as if I had already just bought those and was holding the position. Third, I did get paid for that particular trade, so I have a premium and all those kinds of things. But I'm not looking for theta decay. I'm not doing any of that stuff. Basically, I'll take these off if the market rallies. If the market rallies up to a certain level, I'll just take them off. If the market declines and declines significantly and really breaks to the downside, and I do not want to, be long at 14,800 if the market's trading at 14,500, at some point I would look to see if I get a short signal to actually hedge those. If I don't get a short signal, then I'm not going to do it. All right, so we're getting a little bit into the weeds right now, but all the important takeaways from this are 3 things. 1, please, if you haven't already, educate yourself a little bit on futures and specifically about options on futures. If you are an options trader, you're going to really love this. Secondly, then understand that if you're doing it sort of the way I'm talking about, which is just directionally expressing trades, you're not trying to leg into anything, you're not putting on multi-leg trades, you're not putting on spreads or anything like that in these micro options because you don't need to, because their assignment risk is the same as if you were going long and short, and the margin requirements and capital requirements are very, very negligible, okay? So given that, you don't have to worry too much about this volume. If you have a signal to go long the Nasdaq or the MES, look to express that at about the 50 delta, which would be basically the at the money. So at the time you have a signal to go long 14,800, if you do, or if you had a signal to go long at 14,750, look to instead sell a put at that particular price. Sell a put at that particular price at something around the midpoint price. Just offer that out. And if price gets down there, you're going to get a fill. You're just going to get a fill. Don't do these at market. Don't exit them at market. Don't enter them at market. Just trade them the way they are. And then it's not really important whether the volume is all that great because, again, you're not trying to work orders. You're not trying to get into spreads. Okay. I thought I was going to keep this more for beginners. Hopefully the main points came across. I'll mention them one more time. The CME, great place to understand more about these contracts. Couple brokers where you can trade these if you wanted to try them out on a demo account. I'll leave some links down below there. Start always, at least in what I do, with what's going on in the underlying, okay? I'm not interested in trying to do anything unless I have a signal or setup that I want to express a directional trade in the underlying. That's the first place it starts. When I have that, I go and express it there. The next thing is the multiplier. We talked about the multiplier. In the case of the Nasdaq, it's $2 or $2 per point. times whatever the price is. So if I sold these ones at 83, if I sold them, by the way, generally you're going to sell in the midpoint, but if you really want to get in, obviously you just hit the bid. So that would be $166.50. Okay, is what my credit would be if I were to sell the 14,625 puts. It brings me up one other point, which is occasionally I will have sort of short put stupids or short call stupids. That simply means that I actually am short at 2 different strikes. You don't have to do that. A lot of the time I just ride the horse that I was given to keep things simple so we don't get all confused or whatever. But if I was short here at 14,008 and actually ended up shorting some of the underlying to hedge off that position, and then the market declined all the way down here to 625s, or to 670s, or continue to decline, and I wanted to sell the 14,006 to bring in a little bit more premium, you can do those things as well, because again, it's only one of the underlying. All right, we'll leave it there for now. Hopefully this didn't get too sideways. I'm going to be doing more on this because I think I'm really the only guy talking about it. I've gone on and looked at everybody else, and they're still talking about minis for the most part, and they're still talking about spreads, and they're still talking about doing all kinds of things with these bigger contracts. Now, the one thing that other teaching and training is true is these are very capital efficient. They're super capital efficient, and they're easy to manage, again, because of all the things I've just discussed. So we'll leave it there for tonight. Remember, I'm Rod, the Futures Fanatic. It really does help if you can like, subscribe, turn on the bell notifications. Tell more people about the beautifulness of futures trading, especially for those that want to learn how to day trade. Let's get people off of Forex. Let's get people off of CFDs. Let's get people not trading the stock market when they're worried about the pattern day trader requirement. Like, half the content that's made for stock trading is about how to avoid the pattern day trade requirement. If you have to learn how to avoid a particular requirement, you're either severely undercapitalized, or at least Uncle Sam or regulatory people say you are, or you shouldn't have to go into it with one hand tied behind your back. There's no pattern day trader requirement with these options at all. You could trade as many as you want. And again, broken record here, their only deliverable is one of the underlying. All right, stay green, trade like you mean it. We'll see you at the next one. Thanks.